What's up, Weekend Warriors? Jacob Keane here, research analyst at Henssler Financial, about to show you how to put some bang in your buck on this Casual Finance Friday.
Get down, baby.
So maybe you have a great Aunt Edna that tossed $1 million your way, or maybe you recently sold your Beanie Baby collection on eBay and are wondering where to park all your newfound wealth. You might just be a wolf of Wall Street, but even seasoned vets need to consider one of the key principles of investing: diversification. So what exactly does diversification mean, and why is it so important? Now, some investors, they may say, well, I own Apple and Microsoft, so I'm good, right? Let's start from the top. Most people begin investing by purchasing a handful of stocks. Outside the specific drivers of company returns, the stock market benefits from growth and steady inflation. The market gets upset when growth disappoints, and when inflation is too high and costs are skyrocketing, or when deflation sets in and it feels like a fire sale. In each of these upset market scenarios, there's always another market that benefits: bonds in the event of declining growth and deflation, and commodities when inflation is rising. These asset classes don't all move together. They're uncorrelated, and in the difficult to predict world of markets, this tends to smooth out your returns. Let's look at an example. In the period from 1999 to 2015, a simple 60% stock and 40% bond portfolio beat a pure stock portfolio. The reduction in risk came from the times when stocks were falling and bonds were rising. This is a powerful example of the benefit of diversification across asset classes. But maybe you're a younger investor and you're interested in the superior returns of stocks over time. Well, we can take the same basic principle and carry it into stocks. First and foremost, though we have all undoubtedly participated in a chant at some point in our lives, owning stocks across borders is key. Let's say someone gets an itchy trigger finger and fires a missile headed our way. Your lithium mine in Chile might start looking a lot better than your US airline the next morning. Well, of course, this example is extreme, but countries go through economic cycles at different speeds, and having a bit of exposure in foreign stocks can help reduce your correlations between positions and smooth returns. I also mentioned commodities as an ideal hedge against inflation for things like gold and oil. But typically, if inflation is rising, the dollar is weakening. And this can be another argument for diversifying into international stocks. If the dollar loses value relative to the currency of the country where you hold stock, then you've made money without lifting a finger. And who doesn't want to brag to their friends that even though sales were weak, the Swiss franc was strong and you made a killing in some chocolate? So I've talked asset classes, stocks, bonds, commodities, international investments, and I briefly mentioned correlation. What is this? Think of it as the internal plumbing of the benefit of diversification. Two assets with the same return expectations that do not move in unison should generate the same return as one of them by itself, but with lower risk. We measure how much they move in unison with correlation. And as you can see in the matrix, those closer to 1 move together, and those closer to 0 do not. Further, those below 0 actually tend to move in opposite directions. You can see that commodities, they kind of like to do their own thing. And bonds, they typically move against US stocks. Also, without the sacrifice of return, you can usually get a good bit of benefit from owning foreign stocks. And finally, for all you FANG fanboys and girls, we need to carry this philosophy forward into US stocks as well. Remember, the goal is to be invested in a number of dissimilar areas of the economy that are competing for different shares of wallet. The amount of money you're willing to spend on, say, Caribbean cruises has a significantly different profile than something like white bread. With this in mind, we like to spread our exposure across all sectors, from the growthier, more sensitive ones like tech, consumer discretionary, your Amazons and Facebooks of the world, to the stable, less sexy names in utilities, healthcare, and consumer staples like Johnson & Johnson and Walmart. Take a look at this matrix. You can see how these sectors move with one another. Moving from top to bottom, the tech sector, think iPhones, is highly correlated with consumer discretionary, think autos, and is not very correlated with energy and utilities because, well, we still always have to keep the lights on. So the practice of investing is really about finding positions that complement one another and creating a portfolio that will perform in all environments. No one can be right all the time when it comes to investing. So if you're able to construct a portfolio that limits the damage when you're inevitably wrong, you will see better outcomes. Everyone wants to eat the ice cream, but if it's all you eat, you're eventually doubled over. Try adding some kale to your investing diet. It's good for you. My name is Jacob Keane, research analyst at Henssler Financial, signing off on a very casual Finance Friday. Thank you.